Hey everyone, welcome to the second episode of Market Monocle. If you're new to the channel, Market Monocle is a collection of my thoughts and research on stocks that I think would make money with a focus on positive risk reward. Now in this channel, instead of just reading news to you or rehashing stuff that other people have already covered, I'll try to bring new perspectives and food for thought. Hopefully you find it useful. Since this is only the second episode, I've left this page here to remind you of the core principles of Market Monocle and how I pick stocks. I'm not going to go through each one again, but feel free to let me know in the comments section if there's anything unclear. Alright, so moving on. So in this episode, I'll be answering a question from a viewer that I got via email. So the email I got was, "Hey Market Monocle, I just bought 1,000 shares of KSHB after watching your video. Hopefully it'll moon. By the way, do you follow HITI? If you do, can you do a video on it, why it keeps falling? Everyone says it's super undervalued. Question mark, question mark, question mark." Now, first of all, I'd like to thank this viewer for watching the channel, and I encourage anyone to send me questions, comments, or suggestions in the email found at the end of the video. Now, I think this question is actually very timely. And in fact, I do follow the stock, and I am a shareholder of High Tide for several months already. Actually, even without the question from this viewer, I was already planning a video in the pipeline, but I decided to bring it forward since there appears to be a lot of frustration and angst among shareholders these few weeks. Now, just by looking at the chart, I think this is understandable. The stock has pretty much declined for the entire April thus far, down by around 30% in 2 weeks. And I assume that the viewer is talking about social media and YouTube when she says everyone says it's super undervalued. Just one quick note here though is that even though there's a lot of quality content out there, just be mindful that I've seen lots of misinformation too that is spreading around. So don't just use social media posts or YouTube videos as your only source of information. And yes, that includes this video that you're watching, though I try to make it as informative as possible. Well, first off, the assumption in the question is that High Tide is undervalued. So do I agree? The short answer is definitely yes. Now, I've built a whole financial model on the company to try to work this out, and I'm not going to go through that model today in this video, since the question is really why the stock is falling. But generally, if you look at the valuation using an EV sales approach, it's trading at roughly 1.6 times 2022 consensus estimates, which looks to be pretty attractive given that a lot of its peers are trading at 5 to 15 times. You'll notice I say it is likely undervalued, and this recognizes the fact that I can be wrong, and there are a lot of other unforeseen circumstances or events that can change the valuation quite quickly. You have to keep in mind that valuation is ultimately never a science, but an art that changes with information that comes through every day. Now, valuation means nothing if it's not backed by solid fundamentals. Again, I'm not going to go through my entire thesis here, but if you're not familiar with High Tide, I encourage you to do a quick Google search or watch other YouTube videos, as there's a lot of readily available information out there. I'll just highlight a couple of reasons why I like High Tide. First of all, it's the fastest growing Canadian public company in the cannabis space. This typically demands a higher valuation multiple. Number two, it has a vertically integrated vaping accessories business, which differentiates them amongst some of its peers. Number three, it has a sustainable moat through this vertical integration, but also its scale. It is, in fact, the largest Canadian retailer for cannabis. Number four, it has clear catalysts, the largest being NASDAQ uplisting, but also its strong earnings results and US legalization. Number five, it has a strong e-commerce business, and I believe it owns 2 of the top 3 online stores for cannabis accessories in the world. And lastly, I like the fact that management's interest is heavily aligned with shareholders. The CEO owns around 15% stake in the company. So if High Tide is undervalued, then a lot of people ask, why is the stock still falling? Well, I'll give you 3 potential reasons. The first is that valuation as a standalone measure is absolutely meaningless without the presence of a catalyst. Without a catalyst, a stock can trade at pretty much any price for any random reason, just like macro news, index rebalancing, profit taking. Without the catalyst, even though a stock is super undervalued, it can stay undervalued. Now, the catalyst for a high tide, and the meaningful catalysts, I should say, are the NASDAQ uplisting, a meaningful expansion to the US market, or just general US legalization of cannabis. These are the main catalysts that will really push the share price, and these, unfortunately, have still not played out. A second reason why the stock is falling is that investors are simply reacting to new information. And this latest information that the market is reacting to is the base shelf prospectus on April 8th of 100 million Canadian dollars. This base shelf prospectus allows the company to raise money if required through selling of new shares, which means potential dilution. Now, unfortunately, this dilution could be quite meaningful if the company goes through with the full 100 million Canadian dollars, since the entire market cap of the company right now is merely 400 million. Now, given the uncertainty, I don't really blame investors for selling shares now. But I also think most investors are ignoring why the company has filed this in the first place, which in my opinion suggests that there's a potential game-changing acquisition on the way. In fact, I view it as a very good thing that High Tide is accelerating its M&A activity, given that the deals in the sector has already been heating up in the last 6 months in preparation for a multi-year boom in the cannabis industry in North America. Now, I see many people online immediately concluding that the potential dilution news is the only culprit for the share price slide. I personally don't think it's the only reason, and it's important to evaluate the situation holistically and not fall for confirmation bias. For instance, could it be that the market is actually efficient and that the fair value of High Tide, given what we currently know publicly, is actually under US 50 cents a piece? This doesn't sound particularly far-fetched when considering the stock was up to close to 500% between December of 2020 and February 2021 alone, and that the stock remains one of the most popular penny stocks on Reddit, so there's quite a bit of hype. Despite this contrarian view, let's explore a scenario where it could be possible that the share price could trade at a 40 to 50 cents range. Alright, to start off, we know that the stock is currently trading at roughly 1.4 times EV sales. If you don't know what EV or enterprise value means, to keep it simple, we can simply assume that the EV is the same as market cap for High Tide, since the cash and debt levels are similar, which cancels each other out. In other words, you can assume that the stock is trading at roughly 1.4 times price to sales, and the sales we use is the 2022 consensus estimates. Now let's decide how much we think High Tide should be worth and what multiple it should be trading at once it reaches a steady or mature state. In other words, this is the multiple that we think it should be trading at once it becomes a large cap, is highly liquid, it's well covered by brokers, is traded on major exchanges, is doing business in the US, and basically everything we want High Tide to ultimately be. If we look at its peers and some of the major US cannabis companies, we can see that the valuation multiple ranges from 5 to 15 times. So let's just be conservative and use around 8 times. And this will be our theoretical EV sales multiple. Now, if 8 times is the EV sales multiple that the stock will be trading at once it reaches an ideal state, then we have to discount this 8 times multiple for the various shortcomings of the stock that is present in the company today. So I've identified multiple discount factors, and the percentages in each of these discounts are arbitrary, and it's only based on what I believe to be important. Again, you can have different factors and different discount percentages, but these are what I believe to be important. So in my opinion, the biggest discount is from the fact that it is trading at an OTC exchange and not a major exchange like the NASDAQ or the NYSE. And the implication that this has is that it has a lack of institutional investors. The stock is still primarily retail driven. And ultimately, the presence of institutional investors is required to bring in liquidity and to drive up the multiple. And so I currently place a 30% discount on this, and it basically subtracts around 2.4 turns of EV sales from 8 times. In fact, if you compare the number of institutional investors invested in various cannabis stocks, you'll find that High Tide barely has any. And I think it only has 5 institutional investors as of April 11th versus over 200 different institutional investors in Canopy Growth, in Tilray, in GrowGen. And so, as you can tell, it makes a huge difference. The second biggest discount I would place would be the fact that the company is Canada focused right now and is not yet in the vast US offline retail market. Um, I recognize that High Tide has roughly 10% of sales as of the latest quarter from the US, but that's not going to move the needle. At this point, it's all about the US market. Just to give you a sense, research from Prohibition Partners, they're estimating that the US legal adult use cannabis sales is 6 times larger in this year than in Canada. And fast forward into 2025, that will be the difference between US and Canada would be roughly 9 times. Other more minor factors that could cause High Tide to temporarily trade at a discount today are 1. A small cap discount, which basically penalizes the company for its lack of liquidity in the stock. And even though this is not a fault of its own, it actually discourages a lot of major institutional investors from investing. A lack of liquidity also means that the stock could plunge on very little volume, creating greater volatility on the stock. 2. A discount for the potential dilution risk. And this is exactly what we experienced with its base shelf prospectus. This is inherently a risk for many fast-growing small caps, which tends to be hungry for cash and need cash to grow. But in reality, this really is only a risk if the return on capital deployed is low. 3. I also place a discount on the fact that High Tide is mainly a retailer. Now, in most industries, the retailers trade at a discount to other players on the value chain due to the retailers having thinner margins, are more exposed to the economic cycle, and just generally have more business risk. If you don't believe me, take a look at the EV sales multiples of some major retailers in the US, like Walmart, Costco, CVS, Walgreens. These all have EV sales of actually under 1 times. Lastly, I also place a discount on the short track record of High Tide, as a company has only been listed for less than 3 years, which many institutional investors view as insufficient. While Mr. Raj Grover, the CEO, has done a good job executing thus far, it remains to be seen whether he can manage a much bigger organization and execute well on his M&A initiatives. After all the discounts, the EV sales multiple we end up with is 1.2 times, and this implies a price per share of US 40 cents. Now, I'm not saying that the fair value of the stock should be 40 cents. This is only a demonstration of why it could make sense that the stock has been correcting, or why the stocks appear to be stubbornly trading at around the 40 to 50 cents range. My breakdown of the discount factors also paints a good picture on the impact various catalysts could have on the share price. For instance, if the stock successfully uplists to the NASDAQ just by plugging a 0% discount on the OTC listing, the implied share price would immediately jump to 1.2 US dollars, which is more than 2.5 times the current level. To sum up the key points in this episode, fundamentally, I do believe High Tide looks undervalued. But valuation is meaningless if catalysts don't come through to change the direction of it. A recent negative catalyst was the base shelf prospectus, but this is probably only part of the reason why the stock has been weak. Given what the market publicly knows, a 40 to 50 US cents per share could actually be justified due to various discounts factored in. But once catalysts come through, there could be significant upside to the stock once the valuation re-rates. An 8 times EV sales multiple would mean a more than 400% upside from here alone, even without considering the upward revisions to sales estimates. Lastly, strategic M&A, even if it means issuing new shares and potential dilution, could accelerate future growth, further boosting the long-term valuation of the stock. All in all, this stock requires patience. So that's it for this episode. Thank you for watching. If you like this video, all I ask is that you like the video, leave a comment below, and hit the subscribe button. It takes a lot of time to put these presentations together, and it really helps me kickstart this channel and provide motivation to continue making these videos. Thanks, and I'll see you in the next one.